Bob Anderson opened his portfolio statement in October 2008 and took a slow breath. The stock market had just collapsed. The news was calling it the worst financial crisis since the Great Depression. His neighbors were panicking. His former colleagues were calling him. Everyone wanted to know the same thing. How bad is it? Bob looked at the number on the page. His $1 million retirement portfolio, the one he'd spent 32 years building on a teacher salary in Phoenix, was now worth around $840,000. He set the statement down, made himself a cup of coffee, and went for a walk. Not because he wasn't worried, but because he'd built his retirement to survive exactly this moment.
And it was working. Now, here's what most people don't know about Bob's story. That same market crash that had Bob's neighbors losing sleep, it wiped out 57% of a pure stock portfolio. Bob lost around 16%. Same crash, same city, completely different experience. And the gap between those two numbers is everything we're going to talk about today. Because the fear that gets talked about most in retirement, what happens if the market crashes right after I retire, is real. It has a real name: sequence of returns risk. And it deserves a serious answer, not a dismissal. But here's where I want to be honest with you right from the start.
The way this fear gets talked about in headlines, in scary social media posts, even in some financial content, is almost always built on an assumption that doesn't reflect how most real retirees actually invest. And that assumption changes everything. So today, we're going to look at the actual historical data. We're going to look at what bear markets really did to diversified retirement portfolios, not pure stock indexes. And we're going to walk through exactly what your options are if you retire into a market that immediately turns against you. By the end of this, you're going to see your retirement picture very differently than you do right now. Not through rose-colored glasses, but through accurate ones. Let's start with what sequence of returns risk actually means, because it's worth getting this exactly right. Imagine two retirees, same amount saved, same investment returns over 30 years, but one retires into a strong market and doesn't hit a major crash until 20 years in. The other retires into a crash in year 2. Same average returns, completely different retirement outcomes. Why? Because when you're still working, a market crash is painful but recoverable. Time is on your side. The market drops, you keep contributing, you buy more shares at lower prices, and eventually the recovery lifts you back up. But in retirement, you're doing the opposite. You're selling shares to pay your bills. And if you're forced to sell shares while the market is down, locking in those losses, reducing the number of shares available to participate in the recovery, that damage can compound in ways that are genuinely hard to come back from. That's the real risk. Not just that the market falls, but that you're forced to sell at the worst possible moment. And you can't stop. That is a legitimate concern. We are not going to pretend otherwise. But here's the part that changes the whole conversation. Most retirees are not experiencing bear markets the way the headlines describe them, because most retirees are not sitting 100% in stocks. They never were. They have bonds, they have cash, they have Social Security coming in, they have other income sources. And that changes the math in ways most people dramatically underestimate. Let's look at the historical data, and I mean the actual numbers, not the ones that get cherry-picked to make a point. Going back to 1929, every major US stock market bear market shows two important numbers: peak-to-peak recovery, how long it took from the prior market high to reach a new high, and bottom to recovery, how long it took from the lowest point to get back to the prior peak. Some recoveries were fast. The brief 2020 COVID crash, the 1980s decline. Markets bounced back within months. Others were genuinely brutal. The dot-com crash and the 2008 financial crisis took years from peak to peak. And then there is 1929, the Great Depression. Over 25 years from peak to new high. That number is real. It happened. And any honest conversation about retirement and market risk has to include it. Not to terrify you, but because pretending catastrophic scenarios are impossible would be dishonest. But here is what that table does not tell you. And this is the part I want you to hold on to. That data describes what happened to a portfolio of 100% stocks. It does not describe what happened to a typical retirement portfolio. Those are two completely different things. And most financial content treats them as if they're the same. They are not. You are not a statistic. And your retirement portfolio is probably nothing like what those tables assume. Here's what a more realistic retirement picture looks like. Let's say you hold 60% stocks, 30% bonds, and 10% cash or cash equivalents. A fairly standard allocation for someone in or near retirement.
Now, let's run those same historical bear markets through that lens. The 2008 financial crisis, that diversified portfolio fell roughly 16%. Not 57%. The dot-com crash, about 13% for a diversified portfolio, versus 49% for pure stocks. The brutal 1973 to 1974 bear market, roughly 20% for a diversified portfolio, versus 48% for stocks alone. And look at the recovery times with a diversified portfolio. We're looking at months, maybe a year or two, compared to the 5, 6, 7 years that pure equity portfolios needed to fully recover in some of those same events. This fundamentally changes what retirement looks like in a bear market. Now, I want to be upfront about something here, because this is where I have to be honest with you. The year 2022 is an important exception to acknowledge. That year was unusual because stocks and bonds both fell at the same time, something that historically has been relatively rare.
In that environment, diversification did not work as cleanly as it usually does. Balanced portfolios took a harder hit than the historical pattern would suggest. So we are not sitting here telling you that diversification is a perfect shield. It isn't. There are scenarios where it underperforms expectations. What history does show us is that across most bear markets, a diversified portfolio has meaningfully reduced both the depth of the losses and the length of the recovery. Not perfectly, but substantially. Now let's come back to Bob. Bob retired from 32 years of teaching in Phoenix in 2008 with exactly $1 million. He receives $2,400 a month from Social Security.
And he keeps 18 months of living expenses, $60,000, in a high-yield savings account as his cash reserve, separate from his investments. Sitting there, ready. So when the crash came in 2008, here's what Bob's actual situation looked like. His portfolio dropped from $1 million to roughly $840,000. Painful, but not catastrophic, because he was not 100% in stocks. He had a diversified portfolio that absorbed the blow and reduced his loss to around 16% instead of 57%. And because he had Social Security covering a meaningful portion of his monthly expenses, he was not forced to sell shares at the worst possible moment just to keep the lights on.
He could let his portfolio sit. He could wait. And because he had $60,000 in a separate cash account, he had breathing room. He could draw from that while the market found its footing. He did not have to make a single panicked decision. Most people, when they imagine a market crash in retirement, imagine being trapped, watching the number fall and having no choice but to keep selling into the decline. Bob was not trapped because he had built his retirement so he would not be. Now, let's talk about what your actual options are if you do retire into a serious market downturn, because understanding all of them changes how you think about the problem. Option 1. Continue withdrawing proportionately. This is the textbook approach. Keep drawing from your portfolio in the same proportions, regardless of what the market is doing. Mathematically efficient. Maintains your allocation discipline. But emotionally, it is brutal. You are selling shares while they are on sale in the wrong direction. And most real retirees do not actually do this because it goes against every human instinct. When your portfolio is taking a beating, you tighten your belt. That is not a flaw. That is normal human behavior. Option 2, spend from a dedicated cash reserve. This is what Bob did. If you have set aside 1 to 2 years of living expenses in something stable and accessible, you can draw from that, while the portion of your portfolio that is invested in the market has time to recover. It does not eliminate the problem. A prolonged and severe enough decline could exhaust your cash reserves before the market recovers. But here is the insight that makes this strategy so powerful. Markets have historically recovered before most retirees fully exhausted a well-funded cash reserve. When you look at the diversified portfolio recovery data, most bear markets resolved within 1 to 3 years for a balanced portfolio. A solid cash cushion of 18 months to 2 years has historically been enough breathing room to avoid making permanently damaging decisions. Option 3, temporarily reduce spending. This one is massively underestimated, and it is what most real retirees naturally do anyway. Skip the big trip this year, pull back on gifts, delay the home renovation. Even a 10 to 15% reduction in what you pull from your portfolio during a downturn can meaningfully improve how long your money lasts. And here is the key thing. When you pull back on portfolio withdrawals, you likely still have other income coming in. Social Security, maybe a pension,
maybe part-time work. You are not surviving on nothing.
You are just leaning less on the investment account for a period of time.
Option 4, lean on guaranteed income sources. This is where Social Security, pensions, annuities, and part-time income become genuinely powerful. Not just mathematically, but emotionally. A retiree who can cover the majority of their basic monthly expenses from reliable income sources is simply not as dependent on their portfolio. They have room to wait. They have room to be patient. They have room to let the market do what it does, which historically is recover. Here is a piece of math that puts all of this in sharp focus.
If the market falls 50% and you are 100% invested in stocks, you need a 100% gain just to get back to where you started. That could take years. But if your diversified portfolio only fell 10% during that same event, which is consistent with what the historical data shows is possible, you only need an 11% recovery. That might happen within months. What matters is not how the S&P 500 is performing. What matters is how your portfolio is performing. And those can be dramatically different numbers, depending on how you are positioned. The average doesn't pay your bills. The S&P 500's performance doesn't determine your retirement. Your portfolio's performance does. And your portfolio is not the index. Now, here is where I want to put this all together, honestly, because there is a version of this conversation that becomes dangerously reassuring, and I do not want to go there. Bear markets are real. Sequence of returns risk is real. The Great Depression took over 25 years to fully recover from peak to peak. There are scenarios, prolonged Japan-style stagnation, simultaneous stock and bond declines like 2022, a true once-in-a-century collapse, where even a well-positioned retiree faces genuine hardship. We are not pretending those scenarios cannot happen.
What we are saying is that the version of retirement risk that gets talked about most, the idea that a market crash will inevitably devastate your retirement, is almost always built on assumptions that do not reflect how most prepared retirees actually live. It assumes you are 100% in stocks. Most retirees are not. It assumes you have no other income sources. Most retirees have Social Security. Many have pensions. It assumes you have no cash reserves. Many prepared retirees do. It assumes you have no flexibility in your spending. Most people have more flexibility than they think. Strip away those false assumptions and the picture changes. Not to something perfect,
but to something manageable. Bob Anderson is not a financial genius. He was a high school teacher in Phoenix who spent 32 years showing up and saving what he could. He did not time the market. He did not predict 2008. He just built a retirement that could survive what he could not predict. Diversified portfolio, Social Security covering his baseline, a cash cushion for breathing room. When the worst financial crisis in decades hit in the first year of his retirement, Bob lost around 16%, not 57%. He drew from his cash reserve while the market found its footing. He adjusted his spending slightly. He did not panic sell. He did not make a catastrophic decision.
And within a few years, his portfolio had recovered. Not perfectly, not without stress, but he made it through. And he spent the next decade of his retirement taking the trips he had promised his wife, helping his grandkids with college, and sleeping reasonably well at night. That is what a prepared retirement looks like in a bear market. Not invincible, but not helpless either. So here is what I want you to take from all of this. The retiree who handles a bear market best is not necessarily the one with the biggest portfolio. It is the one who built flexibility from multiple directions, multiple income sources, a diversified portfolio so the losses are smaller, cash reserves so you are not forced to sell at the worst moment, modest spending flexibility so you can pull back temporarily without panic, and the emotional discipline to stay the course when everything around you is telling you to run. None of those things require being wealthy. They require being prepared. So here is the question I want you to sit with, and drop in the comments below. When you imagine a market crash hitting in your first year of retirement, do you feel trapped or do you feel like you have options? One word is fine. Trapped or options? I want to know where people actually stand on this, because I think the answer says a lot about where most of us are in our planning right now. If this hit different, subscribe. Finn posts every week, and he doesn't waste your time.